Hello, my name is Lindsay Shuck. Thank you for joining today's Family Office Network's webinar series featuring Equinox Partners. Presenting for us today is Sean Fieler. Sean graduated from Williams College in 1995 with a degree in political economy. Upon completion of his undergraduate studies, he joined Equinox Partners. He is the firm's managing member, majority owner, and chief investment officer. Sean has spent the last 26 years at Equinox Partners conducting on-the-ground, company-specific research primarily in developing markets and in the precious metals mining sector, which have both become sectors of specialization for the firm. At the end of today's presentation, we will have time for Q&A. Please use your questions chat option on your screen to send over any questions you have, so we can answer them accordingly. With that said, Sean, I'm going to let you take it from here.
Thank you very much, and it's a pleasure to meet all of you, if only virtually here through this webinar. And let me start with a more detailed description of our firm and what we've done. So the firm was founded in 1994 with the inception of Equinox Partners. And for the last 20 years, really since the late 1990s, we've been investing in gold and silver mining companies at some scale. Currently, about 500 of our $600 million under management is invested in gold and silver mining companies in one form or another. There's 10 professionals, 5 on the investment side and 5 on operations, and we're based in Stamford, Connecticut. The mining team consists of myself, 2 analysts, and a geologist with whom we've worked actively over the last 10 years. The 2 analysts are Khalil Van Alphen and Stephen Soroki, who've both been with us now for a couple of years. From a philosophy perspective, how we got to where we are in our concentration in gold and silver mining is we are better business, long-term value investors, and we are contrarian. So we look at spaces, industries that for whatever reason, most other investors haven't gravitated to, and gold and silver mining certainly fits that bill. You have most generalists, I think for good reason, believing that it is a difficult space to invest in. There are a number of company-specific challenges that are insoluble for generalists when investing in the space, and there's some real governance issues. What we found is our long track record in the space, our focus on governance in particular, and the quality of management and the people that we're partnering with actually has been a very good fit for what is really often the largest single risk in investing in a gold and silver mining company, and that's not necessarily the quality of the assets or the politics or the environmental issues, and there's a long list of everything that's also a concern, but the governance and the people that you're partnering with as long-term investors are a chief concern for us. We're launching a new fund to make it easier. Most of the gold money we have today is in the form of separately managed accounts, and we'll be doing that on January 1 of this coming year. And we think we can manage about $500 million, so about double what we're currently managing in the strategy that's identical or very close to what we're doing currently. Here's my bio, as well as of Khalil and Stephen's. Khalil's been doing this for a long time, Stephen for several years, and comes at it really from a background of a generalist, and as I said earlier, I've been actively investing in gold and silver miners since just before the turn of the century. Big picture where we are in terms of gold and silver miners in particular is I think we have some very clear long-term tailwinds here. I don't think they're controversial. I don't think they're difficult to articulate, and everybody in the investing world has seen what has happened to both monetary and fiscal policy and how anomalous it is, how difficult it's going to be to normalize either monetary or fiscal policy, and the current status quo is certainly an enormous tailwind for gold and silver. We think that continues, but despite that background and despite the appreciation that you have really in both gold and silver, where gold is back to its 2011 high, silver is still a long ways off of its $50 highs going back 9 years. The stocks also are a long way off their highs. So it's been a very deep bear market in the sector, where you had at their trough in 15, the GDX and the GDXJ both off more than 80% from their 2011 peaks. So you've had this very extended bear market that we're now have come out of over the last couple of years, but really decimated the sector, really removed a lot of the specialists that had scale in the last cycle from the sector, and discouraged for a long time generalists from participating actively in gold and silver mining, especially in the junior space where we're most active. So that's created, I think, the real opportunity that still exists today. And I think we have a good longer term cycle, whether it's 3 years or 5 years ahead of us. And we're starting that cycle from the perspective of really significant undervaluation and very inefficient or heterogeneous valuation within the space itself. Over the last decade plus, we've got a track record of significant outperformance in the space. Through the bottom, from the peak to trough, we were down 25%, while the indices were down more than 80. We've now outperformed the indices on the upside as well. And so I think our performance in the space really speaks to the importance of stock picking, long-term partnership, and identifying better assets, better people, better boards, better C-suites as long-term investors in the space. Let me go to the next slide here. I think by way of starting this presentation, it's worth recalling the Mark Twain quote, a mine is a hole in the ground with a liar standing next to it. And the longer you spend in the space, and with especially in the junior space, you realize that there's truth to this, that it is probably more than any other sector that is prone to misrepresentation. It takes a long time between when you stick a hole in the ground, discover gold, and produce gold, and that allows for a lot of latitude in terms of what managements, promoters can do with the stories and the companies and the assets that they have during that interval, because the underlying truth of what they have is not going to be revealed during that period of time in their financial statements. It's not revealed in their capital costs or in their capital raise. It's really, there is a lot of flexibility they have in terms of how they represent what they have, and invariably managements and insiders that are wedded to a particular project portray it in the best light. And so that's something, I think that's the caveat emptor I think everybody should remember as they approach investing in gold and silver mining. So let me start with my first point. And the idea here of this presentation is to go through 10 points over the course of a half hour or 40 minutes, and not really, I think, communicate certainly fully what we're doing in each of these sub-points, but give you a sense in terms of what we're wrestling with when we're analyzing these companies. So the first lesson is understanding the C-suite. So I think this is an obvious point. When you analyze a mining company, you really want to know the people. And what's interesting, when most people look at a project in the mining space, when you look at a corporate presentation, the people don't feature significantly enough in that presentation. Usually there's a lot of substance on the technical aspects of the project, the nature of the project, the grade of the project, the size of the project, maybe even the politics or taxation of the project. And the people themselves are often given short shrift, and that's a big mistake. So when you're analyzing a gold and silver mining company, really the the first order of business is usually to analyze the executive who's sitting right in front of you in the meeting. They're almost invariably, not exclusively, middle-aged guys, some middle-aged women. And the reality is that that middle-aged guy often has, in fact, invariably has, at least a decade or two of history in the business. And so what should persuade you is not so much exactly what he says or exactly the story he tells about the asset he has that he's pitching you on in the current company that he's leading, but really his track record over the last decade or two. What has he done? Who has he worked with? Have they been successful or not? One of the real critical questions is, have the people that he's worked with over the last 2 decades, have they moved with him from company to company or project to project? Or do they believe he's going to create more value in the future for the team and therefore they want to continue in their working partnership with him? Or was he somebody that was difficult to work with or ineffective or not a real value creator and therefore somebody they chose not to move on to the next position with? I think this is this line of questioning and really understanding not just technically what they did, but the people that they worked with or the corporate environment in which they worked is really critical to understanding the company that you're considering making an investment in. So you need, I think, to do this effectively, you need a lot of context. So you need to know if they were at these 3 juniors or these seniors in the prior 20 years, what they were doing there, who they were working with, what that team was like, how that company functions, whether that skill set is going to be applicable to the current project they have, and what may be the flaws or the shortcomings that they're going to have given their particular experience. So I have 2 examples here. 2 gentlemen, Clive Johnson, who is the current CEO of B2 Gold, is on the left. And then we have Simon Jackson on the right, who most recently ran Bedell Resources, which has an asset in northern Brazil. I think these 2 gentlemen are interesting because they both had a success in the last cycle. So Clive sold Bima Gold, and particularly the Kupol asset in Russia, to Kinross. That transaction was for $3.1 billion, 2006, was an enormous success, a huge validation of the work that Clive had done in the preceding 10 years. He'd gone to places really people didn't think he would be successful in the late 90s, building a mine in Russia, and he was successful to the tune of $3.1 billion. Simon was not the CEO, but he was part of a team at Redback that was chaired by Lucas Lundin, who has very much, I think, one of the very best reputations in the space. They were also sellers in the last cycle of their company to Kinross. They sold their company in 2010 for $7.1 billion. And so you have 2 gentlemen here who had, I think, demonstrated histories of value creation, success, one in West Africa in the case of Simon Jackson, the other in Russia in the case of Clive Johnson. Subsequent to that, those sales in the last cycle, Clive went on to build B2 Gold, the company of which he is currently CEO, which currently has a $7 billion market cap. He's developed another world-class asset after Kupol. He's developed a coal mine in Mali, in addition to a number of other quality mines. And he basically has a team of people that are able to identify and bring into production really quality mines on time, on budget, in a way that few people in the space are. And so he's done it twice now. Clive is far from perfect, as anybody in the industry will tell you, but he's created a lot of value, and the value that he created in the last cycle is a real sign of the value that he was going to create in this cycle, because he did it in similar ways with the same team. Simon is a less good story. After the success at Redback, he went on to become CEO of an Australian company, Bedell Resources, which has an asset in northern Brazil. And that was something of an unmitigated disaster. The company was undercapitalized. He wasn't on site enough. They got into a dispute with their Australian contractor, and he was eventually forced out by the board just 2 years ago. And so I think the point here is it's not enough to know at a high level exactly what the executive that you're partnering with has done, but you need to have a sense in terms of a real granular sense in terms of what their team was like, what they did in the team, who they brought with them, to get a better sense of their capabilities. So in this case, I think it speaks very highly to Clive's ability to execute, and Simon was just at a different point in his career and when he was CEO of Bedell, and it just simply didn't work. But you could have seen a lot of the signs that wasn't going to work if you went back and carefully looked at his history. The next point I'm going to make is the board. So the board and board members are not going to be in the room generally when the companies are pitching themselves. So they tend not to show up at the conferences, making the presentations, or certainly not in your office as often as the CEOs. And to the extent they do, it's usually only 1 or 2 board members, maybe the chair, maybe a lead director, probably not the whole group of board members. That would be, I've never seen that happen. So, but the board's really important to understand in the mining space, because the board actually makes a lot of the decisions, not just about how management is compensated, but about how to deploy capital, which is one of the most important decisions that's made in this industry. So do you go ahead with the project and build it? Do you sell it? Do you finance it? Do you wait for a better time to finance it, or you wait for a different project? So these are the decisions that are board level decisions, and that are often governed by the backgrounds, the people, the attitudes of the people in the boardrooms, rather than just the technical merits of the project. So if you ask at a high level, how do you decide to greenlight a project or not? Every board will give you more or less the same answer. They only want to do high return projects. They want to be conservative in their assumptions about capital and costs and metal price, and they only want to use the best contractors, and et cetera, et cetera, et cetera. And everybody wants mid to high teens at least return on their project, but in reality, their internal numbers all tell you that the returns will be well north of 20%. The reality is that the same board making the same decision often has radically different assumptions embedded in the numbers that they're using, and they often have kind of different loyalties within the board and backgrounds that are going to affect how they make those decisions. So one of the critical things to understand when you're looking at a board is it a CEO-controlled board? Did the CEO build the board? Are the members of the board really there in some way to help the CEO, or are the board members more independent? Do they have their own agenda, or do they really have the best interest of shareholders at heart? And that's the principal agenda. So what I have here is a series of individuals that have populated a board of a company that we've been invested in over the last 10 years that I think give you a little bit of an interesting feel for what I'm talking about here. So the gentleman on the left is Jonathan Rubenstein. Then we have Dan McInnes, who is the former CEO and still a current board member at MAG Silver. We have Peter McGaw, who is a former board member at MAG and their lead geologist, who really led the geological interpretation that created the value that still is the OneSifio joint venture. That's the vast majority of what MAG owns. And then lastly, we have Peter Barnes, who's the new chairman when Jonathan stepped down. So if you go back to 2012, and that's when we were, along with some other shareholders, involved in talking to Jonathan and trying to figure out how to improve his board. You had at the time a board that was very much controlled by Jonathan, who has been think, a pretty good actor over the years, but didn't own really much in the way of MAG stock, and sat on a number of boards. And he was part of a team along with Dan that had been selling stock in the shares of MAG Silver to finance projects outside of their principal joint venture project, the Juanicipio joint venture. And the logic for that was that the joint venture was valuable, but it wasn't going to cash flow anything for 8 years, and that was too long to wait. And it also offered a basic cash register-like ability to finance and go out and prove up other geological theories, which was something that the CEO at the time, Dan McGinnis, was particularly interested in, as was Peter McGaugh. In particular, they were interested in another project in Mexico in the state of Chihuahua, the Cinco de Mayo project, which is geologically interesting, and certainly there is a resource there, but was unproven, low probability, certainly relative to the Juanicipio joint venture that they had with Fresnillo, and was going to dilute shareholders' ownership of the Juanicipio joint venture because they were selling stock to finance their exploration on the other property. So the trick was figuring out how to get the board to sit still and not use the value they had in the joint venture to finance their other efforts, their other interests, and that involved Dan stepping down as CEO. That involved Peter stepping off the board because of the conflict of interest, and eventually involved, and I think this is kind of a consummation of what has been a very successful process, Peter coming in as chair this past year. And Peter has, he's an accountant by training, and he has expertise in capital allocation, which is exactly what this company, MAG Silver, needed. And that's a big transition from the board that Jonathan had 10 years ago that was principally led by geologists and wanted to build mines and wanted to do stuff, instead of Peter's motivation, which really comes across, I think, very clearly in his history at Wheaton Silver as a capital allocator and a creator of shareholder value, and not interested in taking on projects because they're interesting, but only taking on projects because they're going to generate returns in a prudent way for shareholders. So that brings me to my next point, which is insider alignment. So it's not that the insiders are dumb. It's really that the insiders often aren't well aligned with the other shareholders in the company, in large part because often their economics aren't really driven by their shareholding in the company. So one obvious question to ask is, how much stock do they own, and who amongst the directors actually owns stock? And if they're not on the board principally to generate profits for themselves and other shareholders through their ownership in the company, why exactly are they there? What exactly, what role are they serving? And in some cases, what you find is that there's a class of people that really are in the business of serving as professional directors, and you can get 150, maybe even $200,000+ in compensation for each board that you're serving on. And if you can cobble together 3 or 4 boards, you can make $1 million, and you can get options in your favorite projects without having to put up any capital, and you have to go to a series of meetings and maybe sit on a couple committees. But it's not an unattractive lifestyle, and you have a number of people that have basically gone into that profession. The problem with that is that to get those board appointments, and if you really do see that as your calling to serve on a number of boards, is you're more likely to get appointed to more boards if you're affable and you go along and you don't give the CEO too much pushback on his compensation, and you don't ruffle a lot of feathers on the board or within the company, which is often not exactly what these companies need. Often they need somebody who is more independent, going to push back harder, and is a little more confrontational. And those are basically never the people that get placed on boards by the executives or chairs of these companies, because they can be disruptive and they can mess up the compensation of everybody involved. So in terms of identifying this, the obvious thing to understand is just how much they own. This is a particularly shocking one of a very large, actually well-run, technically well-run company, which is Goldfields. It's a South African-based company. It's got a market cap of over $10 billion. They have a great reputation as technical operators. They have a great reputation as mine builders and operators. They've built a number of on-time, on-budget mines in the last cycle. They've done, as a company, a remarkable job of moving capital out of South Africa to the rest of the world, and done so very successfully over the last decade. When you look at the board is a model of credentials, technical expertise, diversity, you name it. They've checked every imaginable box, with the exception of, I think, maybe the most important one is stock ownership. So the board really, outside of the CEO, owns shockingly little stock. You have a number of directors that have less than $1 million, and many directors that have significantly less than that. It's hard to see how their economics are in any way aligned with the success of the company, other than the company being a going concern at some scale. So the way we see this manifest in terms of the decision making of the company would be the recent decision to hedge a lot of production, even though they say we want to be an unhedged producer. Hedging is something that takes upside off the table for shareholders, which they are, as board members, not significant shareholders, and gives some assurance and guarantee to their stakeholders that they're going to be able to execute on their plans, which may be acceptable, certainly if it's clearly communicated, but given their corporate policy and given their other alternatives, I think this was a particularly imprudent decision that they made over the last couple of years. It really came to a head with their Salores Norte project in Chile, which I think the appropriate thing for them to have done after they got their environmental approvals in 2019 would have been to fund that development out of cash flow, but they rushed to bring it into production, and to do so decided to borrow money, and decided to sell stock, and decided to hedge, all of which made the economics of that production decision much worse than they would have been if they'd just been a little more patient. And one can't help but think part of their impatience was driven by the fact that they simply didn't own enough stock for them to care sufficiently about the dilution and financial risk that they were taking in the hedging. Next lesson. So this is probably one everybody thinks of, is the social license to operate. I think is kind of the best way to capture the compilation of the national politics, regional politics, provincial or state politics, municipal politics, and NGOs and other actors that you're going to face when you're talking about certainly bringing any mine into construction and then production, going through the permitting process, and then in many cases, even once you're in operation. So a good example maybe of national issue where you just have a whole country shuts down would be Gina Lopez, who was appointed the Secretary of Department of Environment and Natural Resources in the Philippines. Surprisingly, after Duterte was elected, despite Duterte being relatively pro-mining, the common understanding is that he made Gina Lopez Secretary of Environment and Natural Resources because her family controls the principal broadcaster in the Philippines, ABS-CBN. He wanted favorable press coverage. She happens to be a committed environmentalist who wanted no mines anywhere, and proceeded to make it as hard as possible to get anything permitted or operate in the Philippines as she could during her tenure in office. At a state level, you can think of, and California is a good example. Equinox, not us, but the mining company Equinox is trying to permit Castle Mountain project in California. That involves the federal government, it involves the California government. It is a real challenge. It may eventually happen, it may not. But looking at one of those processes in detail gives you a sense in terms of how much state opposition there can be to a project. And then here I have a couple pictures where There's some local opposition. This tends to be where you see the people in the street. The one on the left of the screen there is in Turkey. It's Karazli. It's a project owned by Alamos. It's a good project. The problem is it's near a town in Turkey that's kind of a resort town. It's like it's described to me as a Sausalito of Turkey. So beautiful place. People go on the shores of the Dardanelles, which is just a stone's throw from the mine site. And the mayor in that town is part of the opposition to Erdogan, didn't want the mine to go ahead, and was able to really manage pretty significant opposition to it, and the mine's totally stuck. That was peaceful. It's not always peaceful. Latin America sometimes leads the way in not peaceful mining protests. So what I have there on the right is the protests, see a town just outside of the Escobal mine in southern Guatemala. This is a fascinating story where you had billions of dollars of silver underground in a very attractive, environmentally very attractive mine. The mine itself was going to generate 10% of the country's tax receipts. They had opposition from local politicians, basically from everybody that wasn't getting paid, and they had a lot of NGO money come in to fund the protesters to the mine. It ended up getting built miraculously, and then even after it was built and paying 10% of tax receipts in the country of Guatemala, ended up getting shut down. It's still shut down. The shutdown of the mine actually was part and parcel of the reason why Tahoe was sold to Pan American Silver a couple of years ago. And it gives you some sense of what's really at stake when you're trying to bring these mines into production and operate them. One of the very interesting things about the mines and the opposition, and especially the NGO opposition to mining, is it has very little to do with the technical merits of the mine or the environmental merits of the mine. It has a lot more to do with the vulnerability of the mining company itself to pressure. And so Canadian and Australian mines are vulnerable to pressure and will respond to pressure. The Chinese and Russian mines are not so much. Let me go a little faster through this. Asset history, iffy assets. So when you're looking at a company, oftentimes the principal asset or cornerstone of that mining company's asset portfolio will be an asset that was around last cycle. And maybe it had some fatal flaws. Maybe the rock's too hard, maybe the geology is too uncertain. But there's been a lot of drilling on it, and they have a resource, and it looks plausible. And so in an upcycle, that asset gets recycled into a new company. Sometimes it gets named, gets a new name. Sometimes the actual history of why it didn't make it last time just gets downplayed. That's something I think as an investor you just want to be very familiar with. You want to understand, if it didn't make it last cycle, why didn't it make it this cycle? Why did it make it last cycle? Why is it going to make it this cycle? What's different? Or is there a fatal flaw that the old owners just couldn't get overcome in the last cycle? Geology, I think this is the obvious one. I think this is where a lot of generalists have a real hard time with the discipline if they don't have the background. And this obviously is a spot where there can be absolutely fatal flaws. If the gold's not there, or if you don't know, more importantly, exactly where the gold is, even if it is there, your mine's not going to work and it's not going to be economic. So this is a graph of a chart of the gold distribution at a mine that we were invested in the last cycle. It's been sold a couple times and renamed. At the time, it was named Ballarat Gold Mines. It's in Victoria province of state of Australia. And as the graph here shows, they had gold. It's deposited in these quartz veins, but the ground conditions, they've had a number of seismic events over the years, of the millions of years here, and the gold's deposited irregularly. And they thought they knew at the time we were invested exactly where the gold was invested, and they deposited. They built a decline down to 700 meters. They had enough gold to for one Dure bar, and then they shut down the mine because they just didn't know exactly where in these geological formations the gold was, and it was real expensive for them to drift across underground looking for it. And so I remember sitting there in the core shack with our geologist at this mine, going through the cross sections with the company's geologist, and everything was great. The grades were great. The asset was built. The capital was committed. It was all going to work. And as you sat through the discussion, it became obvious to both me and our geologist that they didn't know exactly where the gold was, which over the last decade they've kind of figured out a couple different times, but it obviously significantly damages the economics of that particular mine if the geology is complicated and you don't know exactly where to drift to actually get to the gold that you need to produce. There's a number of other fatal flaws that you can have in a mine. The list is extraordinarily long. This is a picture of the landslide at Bingham Canyon that was back to 2013. It's about 3 billion cubic feet of earth moved. Nobody died in this slide. They had a warning that it was going to happen because the mine was starting to vibrate before the earth moved. But it's not just ground conditions. It's not just pit wall failures. You can have metallurgical problems. You can have rock competency problems. You can have water problems. Either you can have too much water, you can have water drainage problems, you can have not enough water. The list of all the things that can basically make a mine uneconomic or undesirable to develop are too long to list. And this is one of the reasons why you really want to find the right people. The right people tend to go with the better assets, and the wrong people tend to go with often less good assets. And from the outside, it's really often very hard to figure out. And there's always something technically that people on our side of the table probably haven't seen or heard, or can be covered up pretty well from the inside if you're not actively trying to be honest about what you're doing. The next is to know the financing. I mentioned this with respect to the Goldfields decision on Solaris Norte. This is a deck from a company, RTG, is an Australian company with an asset in the Philippines. This is something that you don't often see. Basically, it's an ability to, with a small amount of CapEx, generate the capital necessary to invest a larger amount of CapEx to bring a larger mine into production and generate more value for the shareholders. So this is really a pathway to get from zero to a mine as a junior without having to borrow excessive amounts of money or issue excessive amounts of stock. And that's a rarity. That's something I think all investors should really focus on, is if the asset's not in production, how is it going to get in production and how are you going to finance it? The way an asset's financed often matters more or as much as the quality of the asset itself. Ninth lesson, how the capital is going to get allocated. So this is a slide you almost never see. This is slide 15 in the recent Pan American Silver deck. And this slide shows you how much capital that company has returned to shareholders versus how much money they have spent on capital expansion versus how much money they've spent on business development and how much on dividends over the last decade. Most companies never have this line because most companies have never done anything other than build mines with any excess capital they have. And they're usually borrowing to additional capital and issuing stock to build more mines for capital that they didn't generate internally. Very few people in the business are ever willing to shrink. You don't get awards at the mining conferences for shrinking or not building mines. You get awards for building mines. So you tend to get a huge bias towards mine building. If they don't own a lot of stock, you get a huge bias towards equity issuance and taking on debt if it's available. And rarely do you see a company that's really disciplined enough to return capital to shareholders full cycle, and not just say they're going to do it, but actually do it. So the last point here is valuation, and then I'm going to stop and take questions. So this is your enterprise value to ounce for a variety of companies, and we own 3 of these companies. We own 2 on the far right side of the graph and 1 on the far left. the reason why you pay different values for ounces in the ground have to do with the quality of the ounce, whether the ounce financed, where the ounce is geographically, what the local politics of that are, etc. And so valuation in the case of mining companies has to do with a lot of things that aren't captured in the financial statements, which makes it hard to screen these companies. It makes them hard to be a value investor in a typical value investing framework when you're looking at these companies. But it is possible, looking at valuation metrics, to really be a disciplined value investor in the space. You just have to look at a lot of metrics that are not typical for value investors or are specific to the gold and silver mining space. And here, by telling you that we own both the company at the far left and far right hand of this graph, it tells you that this is important information to have, but alone doesn't tell you whether that company is a good value or not as an investment. So with that, I'm gonna stop and turn it over to my colleague Dan Schreck and you all to manage the Q&A session here.
Sean, thank you so much. Yeah, just to jump in, I just want to encourage questions real quick. Again, Daniel, sorry to interrupt. Use the questions chat option on your screen to submit any questions on over. And Daniel, I'll let you take it from here.
Thanks so much. Sean, first question from Larry. Russia just announced a new gold mine in Serbia, 40 million ounces. Do you have any comments on this discovery?
Sounds good. No, we don't own it. I would say if the question is it a good investment? I don't know enough about that particular project to tell you. The question is the discovery of new gold and increasing in gold mining going to depress or weigh on the price of gold? The answer is no. So two factors there. One is, if you look at the number of 5 million plus ounce discoveries over the last 20 years, it's gone from one every 2 years to almost none ever. And there are some projects that have been brought on in the last 20 years that are 5 million plus ounce deposits, but they were discovered prior to the last 20 years. So there's not a lot of new discoveries to keep that annual pace of almost, actually a little over 100 million ounces a year of production from the gold mining industry. And the other thing to keep in mind is that all the gold ever produced is basically available for delivery at some price. So when you look at the total outstanding stock of gold from a supply-demand perspective, you don't want to just look at the annual flow, which tends to be 1.5% to 2% of the total stock, but you want to look at the total stock. So that's it's about 8 billion ounces. So at current prices, that's $14 trillion worth of gold above ground. And so one mine or two mines, not only does it not really affect the annual run rate of production, it tends not to affect the aggregate. It tends to be smaller in relationship to the total supply of gold.
Thanks, Sean. The next question comes from Richard. Hey, Richard. Seeing as how Equinox are specialists in gold and silver mining, what do you think is in this part of the bull market?
Sorry, what you broke up during the important word in the question. What do you think?
Sure.
What is?
What would be your exit strategy for this bull market?
Okay. So I think one of the when we talk to a lot of investors and prospective investors, they're looking at gold and silver as a short-term trade right now. So they're saying, okay, I've got an interest because I think there's macro tailwinds. I think it's going to work. I don't know if I want to buy the metal or the miners. The miners are bid on the metal would be the standard viewpoint. And I want to know, does this have another 1 month, 2 months, 5 months, 6 months to go? And then I've got to hit exit because everybody knows that this is just a trade. I think that's not historically the way this has worked in the gold and silver mining space, and I just don't think that's where we are today in the space. I think we have, maybe it's 3 years, maybe it's 5 years, maybe it's longer than that left in this cycle. We're a couple of years in. Most institutional investors have nothing allocated to gold and silver. Dan is on the front lines there, and he can vouch for me that that's true. Our clients that are invested, we're not seeing any of the signs of a bubble where people that are, modestly interested in investing in general have specific stock ideas or very interested in particular companies. We're just not seeing that yet in this cycle. It's still, I think, very early. I think the structure that we have, both the monetary and fiscal policy, I think we're still very stuck. The idea that we're on the other side of that, I think it's still very early. And then most importantly, the value of the mining companies themselves hasn't moved. Arguably, it's gone down this year. So the indices are up 30 to 40% for the year, depending upon which index you use. The metal's up almost as much, depending upon whether you're looking at gold or silver. But the companies in relationship to the discounted net asset value of their known reserves and resources has fallen. So I think it's still very early in the cycle, and I think you still have several years ahead of you if the last couple cycles were any indication. So does it happen at some point? Yeah, at some point it does happen, but I think we're very far away from that.
Thanks, Sean. The next question comes from Vikram. I think this is a good question. Do you invest directly in privately held gold mining companies or only public companies? And I might add to it, what are the pros and cons in this part of the cycle?
So we invest exclusively in publicly listed companies. Occasionally we'll invest in an offering of what was, for all intents and purposes, a private company until that listing. But that's a very small fraction of what we do. In a bear market like what we've had in gold and silver mining, the thing that publicly listed juniors offer you is they offer you an unnegotiated price. So the price at which the shares of some of these companies trade is often just irrational. It's very inefficient, and not just in the abstract, but even in relationship to one another. So we'll see companies that won't react to good news, won't react to bad news in some cases. We see companies that have very similar assets, very similar financial characteristics, trading at very disparate values. Part of that, I think, is just the lack of capital that's been allocated to the space over the last decade during the long bear market, the expertise that were taken out of the space over the last decade. So really, I think the best opportunity today is in these non-negotiated deals where you're buying the shares of listed companies that, for whatever reason, aren't in favor, or there's somebody else trying to liquidate, which has created a liquidity opportunity in a particular set of in a particular company's shares. And then the big caveat there is, regardless of the price, you really only want to buy shares and partner with the managements of these companies if you trust the people. And that's really a high hurdle, and that's really why I think there's still very little generalist money, especially in the juniors.
Sean, we've had, thank you, a number of questions, Christina, Vikram, Carl, several others, basically on jurisdiction. Christina asked about investing in the Golden Triangle in BC and Canada. Vikram asked about investing in the United States. I believe it was him. We have a few others asking similar jurisdictional questions. Is there a way that you can boil down in a few principles how to look at jurisdiction and how you apply to our investments?
So jurisdiction is very important. Often the effects of a jurisdiction or the nature of a jurisdiction are counterintuitive, and that's where you can create a lot of value. So if you're of the opinion that Nevada is a good jurisdiction, everybody agrees, and if you find a good quality asset there, you're probably going to be paying a premium price. Not always, and there's in this cycle there's a number of variations around that. Generally speaking, people see, I mean, Africa's many jurisdictions, but Africa gets lumped together as one jurisdiction. The headline news there tends to be bad, A number of projects we've seen, and Tanzania was a great example of one where the jurisdiction of Tanzania is just not where you want to be, and they made that painfully clear to Barrick in the world in their negotiations. But I'd say there's one of the big takeaways of the last decade has been that West Africa is a lot better jurisdiction generally and for the most part than is almost all of Latin America. In Latin America, good projects get stopped for bad reasons often, over and over and over again. And the brain damage that companies have done trying to bring projects online in Latin America, and even after they get shut down, is very well known throughout the industry. And yet, Latin America in general, I think, is seen as, maybe with the exception of Argentina and some Central American countries, as a less difficult jurisdictionally in most people's minds than West Africa. In West Africa, you have now Burkina Faso is the 7th largest gold mining country in the world, and that's happened in the last decade, and that's happened not because Burkina Faso is perfect, but because they've permitted a lot of gold mines. And there's a process, if you have economic deposit, to move through the permitting and to actually bring that asset into production. And it's there's problems, there's difficulties, but West Africa has really done remarkably well. And I'd say that's something where you can buy quality projects in West Africa at huge discounts to NAV, huge discounts to what you'd pay in Canada or the United States, and even in some cases huge discounts of what you'd pay for maybe even more troubled projects in Latin America. And so that's where I think there's a lot of value. The other thing I'd point out would be that the nature of jurisdictions changes, right? Gina Lopez was a particular phenomenon in the Philippines, and somebody like her could come back and shut mining in the Philippines down, or in any other really one of these less developed countries, and really make it difficult to do business. But when she was gone, when she left, that really did create an opportunity, and Philippines rightfully still has a horrible reputation as a jurisdiction. It's mostly well-deserved, but not uniformly well-deserved. And so where we see a lot of value is where you have a perception that is in some ways at odds with the underlying reality.
I think we have time for one or two more questions before 2 o'clock Eastern cutoff. Vikas has asked a number of specific questions, which I think are quite good. Sean, in your opinion, was the Kirkland and Detour combination/merger a good thing? And second part, how do you look at M&A activity in the sector?
Yeah, the Detour sale to Kirkland was great. So this was one of the very few cases of a hostile takeover. Not that transaction, but the effective control that the Paulson funds got of Detour prior to that sale. They had to remove an entrenched board. They had to fire management. They brought in a new CEO who, from when they were able to get control to when they sold to Kirkland, created, even on a relative basis in relationship to the GDX or GDXJ, Detour more than doubled the performance of the indices over that. It was a little over a year-long period from when they gained control of the board to when they were able to sell the company. Detour as a standalone operation, what would it be worth if they didn't sell? I think arguably it would have been worth more today than the price they realized when they sold it, but so are almost all gold mining companies. And I thought Mick was very clear about what his strategy was in terms of displacing the board and monetizing the asset. So I see that as a win. I also see it as unfortunate in some ways, in that the board members involved that were brought into Detour have basically not resurfaced on other boards to the extent that they should have. We have one appointment on a junior board, but some of the very shareholder-oriented people that Paulson brought in, I don't think have gotten the recognition that they should have for the role they played in that process. And we haven't seen any other attempts this proxy cycle. We didn't see anybody else trying to surface value at any company of note. And I think that's regrettable. I think there is still a lot to do for activists in the space. It's not what we do, but we're actively engaged shareholders, but we are not activists. And I think there's still a good necessary role for them. So that would be my take on that particular deal. We were owners of Detour at the time. We voted for the transaction. I think shareholders wanted a larger premium than they got at the end of the day, but it wasn't clear in retrospect there were enough bidders to get a larger premium than what they got.
Sean, let's do one more question. People have good questions, and everyone will definitely get back to you with fulsome answers to all of them. Thank you so much. Once again, Bekas asks another granular question. What are the biggest factors of calculating all-in sustaining cost per ounce of gold? And how much is generally variable and how much is fixed? Isn't this the biggest factor and lesson for gold mining? Maybe first, Sean, you could define all-in sustaining costs for those who don't know.
So all sustaining costs is what are the, not just the direct cash costs that a mining company incurs to produce an ounce of gold, let's say in this case, but it is what are all the attendant costs that they have to produce that ounce of gold and sustain that production. So they have to go replace reserves, they have depreciation from the capital that they put up to build the project. So what are the actual economics of producing that ounce of gold for the mining company? And I think you make the right point, is that most of those costs are fixed. And so the problem with marginal projects is you've committed all your capital when you build the asset, and that is more capital than the marginal capital that you spend to keep the asset in production. And so you want to make sure that you really have a sufficient margin of safety in terms of either a rapid payback or a sufficient actual margin on the mine itself, such that you can be very certain that investment decision made sense. This is why, if you look today with gold at $1,900, the industry is using $1,300 to $1,400 to make their production decisions, because they want to make sure they have a margin of safety. It's capital intensive. This is why the capital allocation decisions at the board are absolutely essential to understand when you're investing in this sector, because you can't fix the economics of a mine often once it's built. It's going to have the cost it's going to have, because most of those are fixed, and there's not a lot of variability. There's not a lot of ability to move the needle there. And if you built the wrong project, oftentimes those problems are insoluble or can only be partially addressed. So it's also, I think it's also part of the opportunity today is you can find projects where you have really an opportunity to generate a lot of cash flow based on free cash flow based on previous capital allocation decisions. And if the future capital allocation decisions are good, you have an opportunity to capture a lot of those free cash flows as a shareholder. So that's one of the things that we spend an enormous amount of time on, is making sure we understand that decision of how to commit incremental capital, because I think as the question rightly implies, most of the capital is fixed in this business, and most of the costs are fixed.
Sean, let me ask one more question, because we have one more minute. I think this is a pretty cool question from Hubert, and it's a little more macro geopolitically oriented. Here's the question. Do you see the trend of central bank digital currencies backed by gold as a good motivation for developing countries to stimulate mining investments?
So I think the central bank digital currency decision and rollout we're going to have over the next year to 3 years is going to be one of the biggest changes in money and central banking that we've seen in 50 years, 40 years. I think it's hard to downplay the significance of it. As for the specific effect on gold, arguably the introduction of electronic payment systems in the 60s, 70s, and the status quo system we have today did not have a large effect on the gold price. gold was outside the payment system before we had electronic payments, and it remains outside the payment system today. I think central banks are very intent, and the G7 has said as much, on making sure gold stays outside of the payment system and outside of digital currencies. I don't see any central bank linking their digital currency to gold, and I don't see any first world country, or really any country, allowing a digital gold currency to circulate. I know people that have tried that. We've invested in a company that's tried that. Regulators are incredibly opposed to that. If you think they're opposed to Facebook's Libra, see what they say when you bring to them any kind of digital gold currency. So eventually, I think the market will prevail. Eventually, I think there will be digital gold currency, but I think it'll have to be in a pretty different system and a pretty different political landscape than what we have today.
Sean, I think that's all we have. Lindsay, if you want to wrap it up, and of course, we'll answer everyone's questions, and we can continue to chat with anyone offline. Thanks, everybody.
Just thank you very much for your attention. I'm sorry I can't see you, and so it's a little bit of a different conference. I hope the points we made were clear, and as Dan said, we're very happy to follow up with you and answer any questions you have. Thank you.
Thank you so much, Sean and Daniel, for joining us today and presenting to all of the FON members. To all of the attendees, this is Lindsay from Family Office Networks, and I will be following up with all of you individually. And as Daniel and Sean mentioned, if there was any questions that didn't get answered, we will make sure we reach out to you directly. And we look forward to connecting with you all soon. Have a great day.